Valuation, the knock speculation. What about the knock of concentration? Nvidia has the biggest weight in the S&P 500 of any individual stock since 1981, since data was being collected. The largest 10% of U.S. stocks now account for 76% of total U.S. market cap. That's the highest concentration in history. The top 10 names in the S&P account for 40% of the index. Does that give you any pause?
I think when people cite these numbers, and I've also heard Max Myers say that, like, two stocks are bigger than, like, Tokyo's entire stock market.
Max is going to love the shout out, by the way.
Yeah.
Anyway, please go ahead.
That we have to think about the earnings contribution. Nvidia is producing incremental earnings at an incremental margin that tells you it's an incredibly scarce company. They're not making enough chips, and they are the center of the AI revolution. So I'm not surprised it's the biggest stock. I think from an earnings growth contribution, it's so big that those previous measurements aren't accurate.
Okay.
Second is that we know that the AI is progressing at a pace that it's delivering real benefits to companies. So companies are now going to see the benefits. I can't point to what it'll be, but it's probably margins. And so that's a story that should be broadening earnings performance.
And I'll end on Nvidia because we constantly talk about them. They did hit an intraday high today, and that was driven by OpenAI's breakthrough AI model release and signals that Tesla may boost its tech spending. Those are two drivers helping fuel this name even higher. So, but it still closed about 1% higher on the day and 5% on the week. John?
Well, Tim, to me, it's really about they're missing AI. So when it comes to Palantir and Microsoft, Godfather AI, Jensen, Nvidia, you could continue to look at the growth next 2-3 years because we're talking about trillions that's going to be spent in the next 3 years. Apple's nowhere when it comes to AI. That's why the multiple is going to continue to be under focus because you don't have that's now playing out. And I think when we were at WWDC in Cupertino, you left there thinking like, okay, was I just in Back to the Future? Because that fundamentally is the problem right now for Apple.
I mean, money flow is everything, right? And so all the negatives that you highlight, institutions are well aware of. It's why it's not as widely held a stock anymore, whereas it's still the most widely held stock in the retail complex. What do you think will make the retail constituent ultimately abandon it? Where most of them have it for 3-4 years, the cost base is so low they don't want to take the taxes. But what would get the retail, the individual, to back away from their beloved Apple?
Look, if we go through, like I said, the next 6 months, 9 months, if we're sitting here at the end of the year and they haven't done an acquisition and AI is nowhere, and we're talking about iPhone 17, okay, we had a color that's orange instead of red, and it's not moving the needle, that's where you start to get nervous because it's my view, like tech stocks are going to be up another 20-25%. You don't want to miss that, but it's AI driven. The AI party, you do not want to look at that from the outside through the window.
From a market valuation of $350 billion at the beginning of 2023 to one that is now approaching $4.5 trillion, Nvidia has had one of the most remarkable stock increases in history. Its rapid expansion can be attributed to the unquenchable demand for its main product, graphics processing units, GPUs. The artificial intelligence AI arms race has led to a surge in the use of these gadgets, and this surge is far from ended. Some of the issues I anticipate Nvidia addressing might lead to tremendous returns for shareholders when the company releases its Q2 FY 2026 earnings on August 27th. I wouldn't be shocked to see the stock soar after earnings, even if Nvidia has had a great year so far. It is quite amazing how much growth Nvidia has produced in response to the demand for GPUs. Although growth has started to decelerate in recent quarters, Nvidia's growth pace, paired with its sheer magnitude, is mind-numbing. Nvidia's growth pace is anticipated to slow down once again in Q2, with management estimating a 50% increase in sales. Although I believe there may be some catalysts for re-acceleration for the upcoming quarter, that is still an excellent number. The resumption of its China business is one of the main reasons I believe Nvidia's stock will jump after earnings. Nvidia's export license for H20 chips, which were made especially to comply with export regulations, was canceled in April. Due to the loss of the world's second-largest AI customer, Nvidia was forced to write off a portion of its quarterly profits. The growth forecast for Q2 was also impacted. According to management, the H20 business will cost them almost $8 billion in lost sales in the second quarter. Nvidia's sales would have increased by about 77% if the amount had been part of management's forecast. There is good news on this front, but it is a big change from the 50% rise it anticipates. Nvidia declared in July that it was reapplying for its export license to China, and the U.S. government promised that it would be approved. According to one source, Nvidia ordered 300,000 H20 chips from one of its vendors to increase available inventory. However, it will take some time for the company's supply chain to resume. Nvidia may just sell what it first believed it would have to write down in the interim. This will probably result in a significant growth boost in Q3, leading management to make optimistic guidance. The stock will probably rise due to the optimistic expectation, but there's another reason why I believe Nvidia might have a fantastic quarter. We can infer some information about Nvidia's quarter from their results because they report around a month after the tech titans. During the Q2 results, almost all of the major IT companies talked about raising their capital spending plans for data centers. Since many of these data centers are occupied by Nvidia's GPUs, this is encouraging for the company. This suggests that there is still a high demand for GPUs, and Nvidia should have no trouble matching or even surpassing forecasts as the quarter progresses. The price tag is the one thing that could prevent Nvidia's stock from skyrocketing after earnings. Even though its growth rate is slower, Nvidia is getting close to its highest trading price during the last few years at 43 times anticipated profits. Even if its anticipated 50% increase is remarkable, it still falls short of the 100% or even 200% growth it has previously achieved. So what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video. We'll learn more after the announcement on August 27th, but given the current state of the stock market, I continue to believe that there's a good probability Nvidia's stock will rise after earnings. The return of the China business will probably accelerate Nvidia's growth outlook, and I believe that catalyst will be the main driver of future stock performance. Despite its undeniably high value, a great earnings report is the one thing that could drive its shares higher even. Will the release of Nvidia's earnings later this month, on August 27th, serve as a trigger to propel the chipmaker's already smoldering stock to new heights? The graph indicates when Nvidia released its profits, as well as the performance of its stock over the last few years. Although there has been noticeable movement in both directions after earnings, the subsequent movement has typically not been either straight up or straight down. This implies that the performance of Nvidia's stock may be influenced by other, far more significant factors, and that the company's high profit figures may already be factored into its valuation. On May 28th, Nvidia last released its financial results. The stock was trading at about $135 at the time, and it has since experienced a significant increase. However, its shares didn't soar in the initial days following the release of its earnings, indicating that the earnings report itself was probably not the cause of its current price increase. The US government just allowed Nvidia to sell its H20 artificial intelligence AI processors to China, which could be the reason for the rally instead. The fact that IT firms continue to anticipate increasing their AI expenditures in the near future is another motivator, suggesting that the market for Nvidia's chips is unlikely to slow down very soon. One may contend that Nvidia charges a high price and is up against more and more competition, including from some of its most important clients. Nevertheless, the company's success and market leadership in AI chips make it impossible to overlook. The most recent quarterly statements from a number of the largest IT companies shared a common message. To meet the need for AI, they are all still making significant investments in data centers. Since Nvidia's GPUs continue to be the industry standard for training and implementing AI models, it doesn't take an investment whiz to see that this is fantastic news for the company. The company's dominance in the market has grown thanks to its Blackwell GPU architecture. With Nvidia currently releasing new products on an annual basis, even more potent chips are on the horizon. However, Nvidia's AI prospects extend beyond data centers. Over the coming years, the company has enormous prospects in the fields of robotics and self-driving cars. Although I don't think we'll see one very soon, another big decline in the price would be a great moment to buy. Right now, the stock is trading below $200. A major obstacle to the AI bellwether's access to a crucial market has been removed as the Commerce Department has begun granting licenses to Nvidia to export its H20 chips to China, a U.S. official told Reuters on Friday. An April restriction on the sale of the H20 chip to China was lifted by the United States last month. In order to adhere to the Biden-era export restrictions on AI chips, the company had customized the microprocessor specifically for the Chinese market. The chipmaker has warned that the limits will reduce revenues from its July quarter by $8 billion. Two people with knowledge of the situation told Reuters that Nvidia CEO Jensen Huang met with Trump on Wednesday. Nvidia representative declined to comment. A request for comment was not immediately answered by a White House spokesperson. The business stated in July that it was submitting applications to the U.S. government to resume selling the H20 graphics processing unit to China, and that it had received assurances that the licenses will be granted to it shortly. The number of licenses that may have been granted, the companies to which Nvidia is permitted to export the H20s, and the maximum value of shipments permitted are all unknown. In April, Nvidia revealed that it anticipated paying $5.5 billion for the limitations. Because it was able to reuse some materials, Nvidia reported in May that the actual first-quarter charge resulting from the H20 limits was $1 billion less than anticipated. Following China's concerns about possible security flaws in the H20 chip, Nvidia declared last month that none of its products include backdoors that would provide remote access or control. With the exception of the H20, Nvidia's other cutting-edge AI processors are still not allowed to be exported to China. In an effort to impede Beijing's advancements in artificial intelligence and military, the United States has reduced its exports of sophisticated processors to China during several administrations. Although this has made it more difficult for American companies to meet the rapidly increasing demand from China, one of the biggest semiconductor markets in the world, it is still a significant source of income for American chipmakers. Without sales to China, where Huawei Technologies was courting developers with processors made in China, Huang warned that the company's dominant position may erode. Nvidia reported in May that the H20 had generated $4.6 billion in sales in the first quarter, with China contributing 12.5% of total revenue during that time. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
A couple product line, pure play company, and yet it's going to have $250 billion in revenue in the next fiscal year. At least that's what the estimates say, and there's just nowhere else to put it. It's now getting a little pricey because it's one of the more highly valued, biggest market cap companies we've had in the last quarter century. So I don't know what to make of it.
$250 billion in revenue, and we're talking approaching a $4.5 trillion market cap.
Yeah.
Not quite, but not far off.
Yeah, and then you get a 30+ multiple on the earnings, and it's obviously the market is extrapolating at least some years of continued superior returns. That's just no way around it. It doesn't seem super expensive on free cash flow, as pointing out yesterday. I mean, Microsoft and Meta are spending all their free cash flow. They're at 50 times free cash flow.
Yeah, by the way, it's notable that so much of their free cash flow now is going towards CapEx, obviously.
It's just shifting it to NVIDIA,
instead of it just going potentially towards shareholders in some way or other. And that has been a big shift for them.
Yeah.
But again, and where is it going? A lot of it's going to NVIDIA.
That's it. And, so far the market's willing to kind of give everybody credit for what they're doing, whether it's collecting the money or spending the money. Although I do see some of the kind of bank shot AI infrastructure trades this week have a little bit of an air pocket. For example, Supermicro kind of been unable to get out of its way. But even if you look at Emerson Electric, Eaton Corp, two of these old line industrials that had kind of acquired the AI electrical build out kind of imprimatur, and then they've, on okay or fine earnings, they did have significant declines this week. So I think that's the push-pull within this market.
That was also the sort of the point behind the downgrade of CAT earlier in the week.
Yes, exactly.
Apollo today. Nvidia now has the biggest weight in the S&P 500 of any individual stock since the data began in 1981. The largest 10% of U.S. stocks now account for 76% of total U.S. market cap. That's the highest concentration ever. And the top 10 names in the S&P, the ones you all know, account for 40% of the index. If that doesn't scream concentration, now that's just the way it's been, and that's just the way it is, and that's the way it will be. Well, does that point to health or not?
It depends on your definition of health. But I want to counter with a really important point that I've made previously, and I'll ride till I die. Nvidia aside, Apple aside, Microsoft is LinkedIn. Microsoft is Activision Blizzard. Amazon is is Whole Foods. These companies, Microsoft is Nuance. These companies are not one company. Obviously, Nvidia is one company. It's selling chips. But the rest of the Mag 7 are like 10 companies, 10 sizable companies, not random companies at the bottom of the Russell 1000, companies that were in the S&P 500, some that were in the S&P 100. So yes, it's fair to observe market concentration, et cetera, et cetera. I don't think there's anything wrong with saying the market is very top heavy.
Is it too concentrated?
Too concentrated defined how? I mean,
I just defined how. The largest 10% of U.S. stocks now account for 76% of market cap.
Yes, it's very top heavy. But if you view Microsoft as one company, then sure, it's very top heavy. If you view Microsoft as, obviously, it's got its huge software business.
We view it as Microsoft. I mean, if you want to break down every acquisition that every company has made and judge them all equally based on that, I mean, this is an exercise in futility.
Fine, but I'm providing some context for the fact that these companies contain other companies which were tens, if not hundreds of billions in size. And I think that's a fair observation.
I do think it's too concentrated, but I think the comment that it's too concentrated is irrelevant because it was too concentrated when the top 10 were 30%. And I can say all I want to about that.